Thanks, Jen, and thanks to all of you for joining us today on our webinar. I'm Nathan Stelter, Vice President of Business Development and Marketing for the Stelter Company. As many of you know who have attended these before, we enjoy providing this series free of charge to all in the nonprofit industry and are committed to providing innovative solutions and education for all of your marketing needs. Extremely happy today to provide this complimentary webinar presented by our very own Lynn Gaumer, as well as Larry Katzenstein. Give you a little bit of information in regards to both of our speakers. And actually, before I do that, we've had such an outpouring of interest in this webinar. So as many people are still joining us, over 1,000, around 1,400 individuals signing up for this. We are actually going to do, so if there's peers or anybody else that would be interested in this, we're going to do an encore presentation of this in 2 weeks on Wednesday, February 7th at 2 p.m. Central Time. So I know a lot of you will wanting to spend your lunchtime right now talking about tax reform. You can do the same in 2 weeks, as we'll be providing this webinar again live at that point. On to our speakers. As I mentioned, Lynn Gaumer is our Senior Technical Consultant here at the Stelter Company. Lynn's been with us for just about 7 years now. Prior to coming to Stelter, Lynn worked as an Associate Attorney for 10 years with Duncan Green, Brown & Langton PC, a law firm here in Des Moines, specializing in estate planning, charitable planning, probate, guardianships, conservatorships, real estate, and business planning. Her Bachelor of Arts degree in Economics and Communication Studies from the University of Iowa, and a law degree from the University of South Dakota School of Law. Currently, she is our president-elect and board member here at the Mid-Iowa Plain Giving Council and a member of the National Association of Charitable Gift Planners Leadership Institute. Larry Katzenstein, partner at Thompson Coburn, is actually one of our Stelter's technical advisory board members. We are very excited to include him today as he's a nationally known authority on estate planning and plain giving and is a frequent speaker, some of you may have heard around the country, to a variety of professional groups. He appears annually on several American Law Institute estate planning programs and has spoken at many other national tax institutes, including the Notre Dame Tax Institute, the University of Miami Heckerling State Planning Institute, and the Southern Federal Tax Institute. He's a former chair of the American Bar Association Tax Section Fiduciary Income Tax Committee, an active member of the American College of Trust and Estate Council, and creator of the Tiger Tables actuarial software, which is widely used by tax lawyers and accountants across the country. So with no further delay, I will hand this off to our two speakers.
Thank you, Nathan and Jen, for that introduction, and thank you again to Larry for co-hosting this tax webinar with me. I can't think of a better person and somebody who has more experience in this area than Larry, so thank you, Larry, for co-hosting with me. We've got a very full schedule today. I have the agenda up on the screen here. First, we're going to go over some of the key provisions of the Tax Cuts and Jobs Act, those provisions that are most impacting your nonprofit and your donors. Then I'm going to talk about the top gifts to make in 2018. Those are the gifts you should be focusing on in your marketing materials. Then Larry's going to go over some new strategies in 2018, and these are some very interesting things that you should be talking with your donors, especially when it comes to charitable gift annuities. Then I will come back on and talk about some best practices and summary and next steps, and then we will reserve some time for your questions, and Larry will be answering those questions. If we do not get to your question at the end of the presentation, our contact information will be on one of the final slides, and feel free to email either Larry or I with your question, and we will be able to answer that shortly after the presentation today. So let's get moving, and we are going to first talk about some of the key provisions of the Tax Cuts and Jobs Act. But before we do, let's talk about some key dates. December was kind of crazy in regards to tax reform. If you recall, Senate had their version of the tax bill and the House had their version. They had to come together and reconcile it into one bill, and then that bill had to be voted on. And it was first voted on by the House, and then it went to the Senate, and then it actually went back to the House, if you remember, because to clear up some technical errors. And then it was finally signed into law by President Trump on December 22nd. Only 8 days later, these provisions took effect. The bill is over 500 pages long, so I think many tax advisors and financial advisors are still getting through these provisions, looking at what the bill actually says, and advising their donors. So there could be some delays that I've heard just from in the industry of some major gifts that the advisors are trying to get through all of the provisions and determining the best situation for their donors. So you may see that. Many of the provisions affecting individual taxpayers will sunset on December 31st, 2025. And those will include most of the things that we are talking today, such as the tax rate, standard deduction, child tax credit, and estate tax exemption. What happens after that is unknown at this point. There could be an extenders package passed at that time. They could allow them to sunset, and then we would go back to the rates that were in effect in 2017. So let's first take a look at some of the things that have changed. Income tax rates and the brackets. This here is a good resource for you for single filers. And as you can see from the chart, many of your donors will have a decrease in their tax rate. So for example, if you take a look at somebody earning $100,000, in 2018, their tax rate would be 24%. In 2017, that rate was 28%, so a decrease of 4%. If you've got a donor who's single and earns $75,000 a year, that rate was 25% in 2017, and in 2018, a decrease of about 3% to 22% in 2018. Next, we have the brackets for married filing jointly. And again, many individuals will see their tax rates decrease. The top rate decreased from 39.6% to 37% on both single filers and married filing jointly. And again, if we look at some examples here, we have somebody earning income of $200,000 in 2017. They'll be at a 28% tax bracket, and a 24% tax bracket in 2018. If you have a married filing jointly couple earning $100,000, they would have been at a 25% rate in 2017 and a 22% in 2018. So what does this mean? It means that many of your donors will find themselves with more disposable income due to the lower tax rates. And this may be an opportunity for them to give more to your charitable organizations. And I know in my personal circumstances, I will be decreasing, and my husband and I already have talked about that we may be giving more to charitable organizations because we have a decreased tax rate. The standard deduction is something that I think has posed the most concern for nonprofits. The standard deduction nearly doubles in 2018. So you see the chart there. In 2018, for single filers, 12,000, heads of households, 18, and married filing jointly, 24,000. So again, this is something that's most concerning to nonprofits because the number of itemizers will greatly decrease. And so not as many individuals will be taking the charitable deduction. The Joint Committee on Taxation estimates that there were 46 million itemizers in 2017, and that will drop to about 20 million in 2018.
I might just add a word.
Oh, yeah.
If I could just add a word about that. You know, on the one hand, donors may think, well, I'm not getting my charitable deduction anymore. But if you think about it a different way, it really doesn't matter because Congress gave them the deduction. So they get it automatically up to that $24,000. So in that range up to $24,000, they should come out the same.
Yes, thank you. So what does this mean for nonprofits and your donors? Well, there will be a change. I mean, there will be, I think, less people itemizing and more people taking that standard deduction. But let's think about this. Many donors will give to your organizations because they want to make a difference. They want to make an impact. And Stelter research has shown over and over again that tax incentives are at the bottom of the list. So I think these donors will continue to give regardless of whether they're going to be taking the standard deduction or itemized deduction. Another point is the economy is good. The stock market is up. There's a lot of people who are employed, and unemployment rate is low. So you've got a very good economy here, and when there's a good economy, people have more disposable income. And with the tax rates decreasing, again, increased disposable income. Many donors in the higher tax, like coastal states like California, New York, New Jersey, and Oregon, those individuals will most likely still be taking the itemized deduction for charitable deductions, because I think they'll be maxing out on the itemized deductions for their for what's called their SALT deductions, and Larry's going to go over that a little bit later, but that's for state and local taxes. So those individuals, I think, will also be remaining and taking those individual charitable deductions. So what does this mean? There may be a shift in the way donors think about giving in 2018 and think about itemized deductions versus standard deductions. And one of the types of gifts that might come up, and we're going to talk about this a little bit more later, is called bunching gifts. And it might be an incentive for some donors to give more in one year over another. So, for example, they will give more in 2018 and then take that itemized deduction, maybe give a little bit less in 2017 and take a standard deduction. We're going to go over that a little bit more later. There's also going to be an increase in interest in donor advised funds because of the standard deduction. Again, they may be bunching their gifts in one year over another, but not ready to make a decision on which charities to give. So what they may do is open a donor advised fund and bunch their gifts into one year and then make those distributions over maybe that year and the following year.
Hey, Lynn, this is Jen. I'm sorry to break in for just a minute. I'm hearing that we're having some audio problems, so I'm just going to have us mute for a second and see if we can make some adjustments. Okay, we made some adjustments, and hopefully you'll be able to hear Lynn better, but if you can't, please go ahead and write into the question pane and let me know, and we'll see what else we can do. Thanks.
Okay, hopefully we got everything finalized here with my headset. Okay, so the other interest will be the IRA charitable rollover, and I think there's going to be an additional interest in this gift. Again, with this gift, and I'm going to go over it a little bit more in the best gift section, but with this gift, of course, it doesn't matter if you don't itemize or not. It helps those 70.5 and older, and it doesn't matter if you're taking the standard deduction or itemizing. Finally, the personal exemption. The personal exemption is eliminated, and it also, another provision is that it increases the tax credit. So when you talk about all the things that have to go in impacting a donor's taxes, there's going to be a lot of moving parts here. There's going to be the tax rates. Of course, they decrease, but there's going to be the higher standard deduction and whether they take that or itemize. Now, of course, the personal exemption is eliminated, but they get a higher tax credit. So each donor is going to be unique, and I do encourage you to encourage your donors to meet with their tax and financial professionals to determine how this tax reform will impact their unique situation. I'm going to turn this now over to Larry, and he is going to go over a few more provisions of the Tax Cuts and Jobs Act. Larry?
Good. I'd like to just emphasize one thing that Lynn mentioned, which is that I really think it's pretty clear from the academic studies that marginal rates don't affect charitable giving very much. And as always, we have to make sure that our charitable clients emphasize the charity rather than the tax benefits, because that's why people give, not primarily because of the tax benefits. So let's talk about some of the other changes in more detail that are in the new tax law. First of all, and I think some donors don't understand this, the itemized deduction for the charitable contribution is unchanged, except for one minor change, which is beneficial. But the deduction is still there. What is different is the threshold before you're able to use the charitable deduction. And that has become more serious because of the elimination of the two largest deductions which many of our donors have. First is the mortgage interest deduction, and that is now limited to the first $750,000 of principal value. In addition to that, and this has gotten less attention, they have deleted until this phase-out ends in a few years, the home equity loan deduction completely, including old ones. So those old home equity loans are not grandfathered. So that deduction has been substantially reduced for mortgage interest. The other thing that had a large effect, of course, is the limitation for state and local tax deductions to a combined $10,000 for those taxes. And you can use a combination if you're in a state which doesn't have an income tax, but you do have property taxes of $10,000, you can deduct them. And if you're in a state which has just the opposite, the same is true. It's any combination of state and local income, sales, and property taxes, and that deduction is now limited to $10,000, which means that for many people, they will not be itemizing their deductions. In addition, if you want to go to the next slide, the medical and dental expense deduction is still there, but with a lower floor. That floor is 7.5% of AGI, and that will be in place for 2 years, beginning in last year and this year. The loss deduction is repealed through this sunset period, which ends in 2025. And finally, and this one I think will affect a significant number of people, the miscellaneous itemized deductions, which are subject to the 2% floor, has also been eliminated for those periods through 2025. The most common ones for many people would be the amounts they pay for tax advice, or the amounts they pay for tax preparation, or for estate planning advice that's related to taxes. Those kinds of miscellaneous itemized deductions are completely eliminated. And what that means is that many people, as Lynn said, will not be itemizing their deductions, and we'll look at the effect of that for charitable giving. The one change they did make, which is beneficial, although I can't believe it's going to help many people, is that the limitation to 50% of adjusted gross income for cash contributions to public charities has been raised to 60%. I am a little bit skeptical this will help too many people, because most people who are giving gifts that large of more than half their income will probably be using appreciated securities, and this increased limitation only applies to cash gifts to public charities, not the gifts for private foundations, and not gifts for any asset which is not a cash gift. In addition, the estate tax exemption has been doubled, and there's a little bit of uncertainty what that exemption actually is going to be. It would have been $11.2 million if they simply doubled it from the previous $5.6 million. But what has changed is that the new law says that when you calculate that automatic built-in addition every year, which is based on the consumer price index, they're now using what's called a chained consumer price index. And what that does is take into account behavior that doesn't just look at how much prices go up. So the way that it's usually explained is that under the old system, if the cost of beef went up by X%, then that got automatically put in the CPI calculation. The new chained calculation would figure in that some people, when the price of beef goes up, will switch to chicken, and therefore their cost of living won't go up as much. So that chained CPI application would probably mean that we will have an estate tax exemption of $11.18 million rather than $11.2 million for 2018, and of course for a married couple is twice that. That means that, among other things, only a few people in our society will be subject to estate tax, and it means for charities that emphasizing the estate tax benefits of charitable giving will be less important for most of our donors. Those donors who are not going to be subject to a state tax, and that includes most of us, now have really a much greater incentive to make their gifts during lifetime where they might get some income tax benefit, especially if they can make them in a large enough amount that they can deduct them. And so there are a number of ways that those of us who do try to take advantage of that. One of them is if we have a client who has a bequest to charity in a will, we will typically make certain attorney let the attorney, in fact, prepay those bequests during lifetime. So you can, again, bunch into lifetime and get a deduction for those. And what the attorney, in fact, can do is go to the charity and say, this individual has a bequest in her will to you. Are you willing to accept this gift now, charity, instead of later? And that's an offer every charity will accept. And then you get the deduction in lifetime, which would produce no estate tax benefit and no income tax benefit if made at the donor's death. And similarly, when we write revocable trusts for clients that provide for a charitable gift to be made at death, we will always include a provision authorizing the trustee to prepay those during lifetime if the trustee thinks it would be beneficial. And again, that enables someone who wouldn't be getting an estate tax deduction anyway, either because they're lower than the new limits or because everything's going to charity anyway, so there wouldn't be an estate tax, to accelerate those into lifetime, or you can, because of the bunching effect, among other things, get this income tax deduction. And the final thing, as I mentioned before, is that these non-tax benefits become so much more important now to our donors. The next thing that the new tax law did was repeal this PEAS limitation, which reduced itemized deductions by 3% of the adjusted gross income over a threshold, or if less, 80% of the deductions. And so that PEAS limitation, which in some cases reduced individuals' charitable deduction benefits, is now gone. And let's go next to the slide on endowments. Maybe the next slide. The other thing that the new tax law did, and I think this is a very bad public policy, is it created a new 1.4% excise tax on the investment of income of some private colleges and universities with more than 500 students with assets of at least $500,000 per full-time student. So this will not affect too many charities, but it will affect the largest colleges and universities. This only applies to private colleges and universities because, as a constitutional matter, the federal government can't tax state and local entities, but it will affect private colleges. I saw something this morning which I thought was interesting. The president of Harvard has estimated that Harvard would have had to pay about $40 million in its investment earnings during the fiscal year ended last June 30. That's a big number. And one thing that this may mean is that colleges and universities may want to emphasize gifts which they will expend for projects rather than for endowment gifts. And short-term projects, or for projects that will be a program that's not an endowment gift, may be more appealing than to solicit, because they will not then be subject to this excise tax. So I think this is bad public policy, but there it is. And I know that there'll be lots of letters written to try to. The other thing that the new tax law does is it imposes a 21% excise tax on nonprofits that pay compensation of $1 million or more to any of their 5 highest paid employees. Now, there's some exceptions, for example, for licensed medical professionals, to the extent that their income is earned from providing medical services. That also applies not only to physicians, but to veterinarians, which I was glad to see. My daughter's in vet school. Finally, the other thing that was changed, and I don't think this got much publicity, but it's an interesting one. Under the old law, if I gave money to a college or university, and in exchange for that contribution, I didn't actually get the tickets to the football games, but I got on the coveted list of donors who were entitled to buy the tickets, then I could deduct 80% of my contribution. And that has been eliminated, and now I will not be able to deduct any of it if I'm getting the benefit of getting on this coveted list of donors who have the opportunity to buy tickets.
Okay, thank you, Larry. We're going to go on to our next section now on top gifts and what you should be focused on. Really because of either tax reform or economic currently happening. So let's go on to gifts of appreciated stock or property first. First of all, stock market is at or near all-time highs. I looked at it this morning, and it's again increasing. Many real estate markets are experiencing strong growth as well. And the Tax Reform Act did not touch the capital gains tax rates. So they remain at 0, 15, and 20% for those, and 20% would be for the higher those in the higher tax rates. And it also remained untouched for for both types of capital gains, that 3.8% net investment income applies to certain high earners will also stay in place. That did not get changed at all under the new law. So here's some marketing ideas for you. Gifts of stock. Definitely many individuals own stock in their portfolios, and more than likely they have a lot of gains in them right now. So they are great gifts to give. And like I said, the capital tax rates did remain in place. Gifts of real estate. Again, real estate markets are enjoying some gains, and the capital gains tax rate remains in place. So that might be something you want to focus your marketing on as well. Charitable gift annuities and charitable remainder trusts. These are ways donors can increase income and then these are messages you can focus on regarding focusing on income rather than tax benefits. Both work in the same way in that they pay income out to, in charitable gift annuity case, 1 or 2 people. And in charitable remainder trust, you get a little bit more flexibility. You can pay for more than 2. Typically, charitable remainder trusts are for those higher net worth donors, and charitable gift annuities also work in the same way where there's income and then it benefits the charity. If you are an organization who does not promote charitable gift annuities at this time for reasons like either you are just a small one-person shop or that you do not have the resources to handle charitable gift annuities from an administration standpoint. Maybe your board does not want to take on the liabilities. There are options for you, and many of our clients have worked with the Charitable Giving Resource Center that is actually here in Des Moines, and I do know a number of them over there, and so feel free to private message me if you'd like more information on that. You can also Google Charitable Giving Resource Center, and they can certainly help you with your gift annuity program. Another question that I've actually been getting is whether the ACGA rates and annuity rates changed with tax reform. They did not. Those are reviewed typically twice a year in November and April, so those have stayed the same. With a CRT, you can get a little bit more flexible with those rates. Typically, though, the payout rates are between 5 and 7%. Okay, retirement plan asset, commercial annuities, and savings bonds. These all have one thing in common in that they have income yet to be taxed. Retirement plan assets, they're best given as a beneficiary designation. And of course, we've got the IRA charitable rollover, which are both great ways to give. Commercial annuities, best way to give those is, again, a beneficiary designation. And savings bonds, the best way to give those is through a specific bequest in the donor's will. So this is all looking at income tax ramifications on these types of assets, so all good assets to promote in 2018. Retirement plan assets, again, they remain taxable when distributed to a beneficiary. If you're distributed to your heirs, so for example, if your child is in the 37% tax bracket, when those distributions are made, automatically 37% will be taxed. So again, if you they are high tax assets, and so if it's much better to give to a charity, which of course, when the proceeds of retirement plan assets pass to a charity, it passes tax-free. IRA charitable rollover, a great gift to make in 2018. And one of the top questions I received about this gift is, did it change? Did they expand this? Did it change in any way under tax reform? And the answer to that is no, it did not change under the law. So I have some of the details of the gift, so that all remains the same. I am hopeful that there will be an expansion of the IRA charitable rollover in the future. I know that they've talked about a couple things about expanding it to donor advised funds or expanding it to split interest gifts like CGAs and CRTs, but nothing has happened yet, so I guess we'll just have to stay tuned. The IRA charitable rollover gift is great because it's beneficial regardless of whether the donor itemizes, and the gross income does not count is excluded from gross income and counts towards the donor's required minimum distributions. So make sure that you segment when you are talking about the IRA charitable rollover. Just as a reminder, this is only for individuals 70 and a half and older. So like if you're sending a blast email out, make sure that you are segmenting this to your donors who are 70 and a half and older, so that those in the 50, 60-year-old range aren't getting material that's not relevant to them. Donor advised funds, I think this will we'll see an uptick in donor advised funds. This has been gaining popularity for many years now, even before tax reform. Over 85 billion assets are in donor advised funds now, and that the number of donor advised funds continue to rise. I did just see an article in the Chronicle of Philanthropy this morning that the number of new accounts at Charles Schwab Charitable jumped 91% in the second half of 2017 over the same period in 2016. I think you may see donors bunching gifts. I mentioned that earlier, and Larry's going to talk about it in our next section here, but they could be creating a donor advised fund, bunching their gifts, and then making distributions over a certain time period when they're ready to do so. Grantor Charitable Lead Trust, this would only be a marketing opportunity for those who are definitely high net worth. And it's a kind of a different way of thinking. And some individuals I've talked with and clients and development officers don't really realize that there are different types of charitable lead trust. There's grantor trust, a non-grantor trust, of course, annuity trust, and unit trust. But with this high exemption, estate tax exemption amount, many individuals may be looking for more income tax relief than estate tax relief. So there may be a shift towards the grantor charitable lead trust in this. And then we're expecting interest rates to rise. And I'm already seeing that with the CMFR rate, which is in January is 2.6, in February it's going to be 2.8. So this opportunity is better for the low interest rate environment. So you may want to talk to them about this sooner rather than later. So I just wanted to give a couple of resources here. I'm not going to get into the real details between grantor and non-grantor charitable lead trust, but really the non-grantor charitable lead trust, all the assets in the end do not revert back to the donor, and so they pass estate tax free. They'll pass automatically to the heirs. In the grantor charitable lead trust, the grantor is the owner of the trust, and when they make that initial transfer, they can get an income tax charitable deduction for the present value of the future payments that will be made to the charitable beneficiary. It's just a different type of trust that I think may be a little bit more popular in 2018 than it was in 2017. I have an example here just to go over briefly, but in this situation with a grantor lead trust, it's really for that individual donor who is going to expect a windfall of income for one reason or another. And so their attorney may decide that this type of trust is best for them. It's a great trust that benefits you as the nonprofit for usually a period of years or a lifetime. And in this situation, George receives a significant income tax charitable deduction and is able to carry that over for 5 additional years in the event that he needs to do that. So again, grantor lead trust, another marketing idea, but really make sure that you remember that this is only for those very high net worth people, so very specific for that group. Okay, Larry is going to talk about some strategies for 2018. I have found his comments very interesting, so go ahead, Larry.
Okay, let's talk first about charitable gift annuities. Typically, gift annuities are gifts that smaller donors making smaller contributions will make. If it were a larger gift, they would probably do a separate charitable remainder trust. There's one thing that's different now under the new law, the effect of not having a charitable deduction in many cases, and the person who takes out the charitable gift annuity is in that class of persons not as likely to get a charitable deduction because they might be smaller gifts. But a couple of things about the new law that affects it. One is that because many of these donors who purchase charitable gift annuities will not be itemizing, it means that maybe the choice of the interest rate that they use when they value the gift will be different. As you remember, when you take out a gift annuity, as well as with some of these other split interest gifts, you can use the federal interest rate that's either in effect for the month of the gift or for one of the 2 prior months. And with most gifts, whether it's a unit trust or a lead trust, automatically we know which rate is better. The gift annuity is unique because a higher interest rate choice is better from the standpoint of producing a higher charitable deduction, but a lower interest rate is better from the standpoint of how much of each payment is taxable. And so rather than automatically defaulting to the higher interest rate of the 3 months, I think now it's important for charities to ask their donors whether they will be itemizing. Because if they are not itemizing, which will be more the case this year and following years than it has been in the past, they should probably elect to use the lower interest rate. And there's an example of a slide on the next page, and if you want to change the slide, you can see that. I have an example here of a 72-year-old donor making a $25,000 gift of a purchase of a gift annuity, and the annual payment will be $1,350 in each case. With the higher 2.6% interest rate, which many donors would have taken in the past, they would have gotten a higher deduction, $10,952 rather than $10,496. But now that many of these donors, Mary in this case, will not be itemizing, they are better off using the lower interest rate because you can see that more of the annual payment will be tax-free than it would have been with the choice of the higher rate. So I think it will be more important than it has been in the past to ask donors whether they will be itemizing. And then the charity has to know that because when they report the payments to the IRS and to the donor every year, they have to know which rate the donor will use on the donor's tax return. So I think that's going to be important. The other thing about charitable gift annuities is because of these new limits on itemized deductions, it may mean that donors will be inclined to, in effect, prepay charitable gifts by taking out a charitable gift annuity. And it also may mean that some donors will prefer a deferred annuity because with a preferred annuity, not only does the payment rate go up, but in addition, the deduction is higher. And there's an example of that in your slides. The next example is on page, here's the Robert, age 75, is considering a gift of $20,000 as an immediate or deferred annuity. And you can see here that if it's deferred for 1 year, the annuity rate goes up from 5.8 to 6.2%, but in addition, the deduction goes up. And maybe it will go up enough that it pushes the donor up into that category where the donor will be able to itemize charitable deductions. So And I think that's a strategy that will appeal to many donors. The higher deduction, I think, may influence how donors give in other ways too. Lynn mentioned the fact that there will be an incentive now to bunch gifts. So if I can't deduct my charitable gifts because I haven't given enough this year, what I may want to do is go to the charity, for example, and say, I've given you $10,000 a year, and I'm concerned about the deductibility of my future gifts, so I'm going to give you $50,000 now, and this is my $10,000 gift for the next 5 years. That would be one way to accelerate the deduction so that you bunch deductions in a single year. Other donors may find that it makes sense to pre-fund their charitable gifts in effect by creating a donor-advised fund. And then I put $50,000 in my donor-advised fund. Every year I have the donor-advised fund pay out the $10,000 that I've been making every year in annual contributions to my favorite charity. So that will be another strategy for bunching gifts. There's an example in the materials of Don and Christy, who claim the maximum state income tax deduction of $10,000, also have mortgage payments of $8,000. So they dollars to charitable cross that standard deduction threshold to a married couple. They normally give $4 on an annual basis. They might want to give 2 years worth of contributions in the 1 year, and then they'll be able to take a tax deduction a year earlier and be able to get a deduction this year and then take the standard deduction the following years. So this will take a lot of fine-tuning for donors, but I think the prepayment and bunching of contributions will become a popular way to make certain that donors get the benefit of the charitable deduction. The estate tax exemption increases we talked about before to probably $11.18 million per person, or twice that for a married couple. And I think this may also encourage lifetime gifts for high-income donors. Rather than making a bequest at death which will not produce a tax benefit, why not try to accelerate some of those into lifetime? I've had cases of clients who had bequests and wills, and I remember one case I asked the individual, why shouldn't it just go ahead and make the gift during lifetime? She could afford it, and she got the benefit of actually seeing her gift put to use during her lifetime, which is another benefit of the lifetime gift, which you obviously don't get with a bequest. And finally, the economic outlook is very healthy now. That means that interest rates are going to go up almost certainly. And this may encourage donors to think about certain particular kinds of gifts rather than other kinds of gifts. And the kinds of gifts that I think that calls to mind are ones that benefit from a low charitable monthly federal rate. And the two that are particularly affected in this way are, first of all, the gift of the retained life estate in a residence, and second of all, the lead annuity trust. There's an example in the materials showing the effect of rising interest rates on a retained life estate, and we have an example of Vanessa, who is 72. If you want to go to the next slide, and she's been considering a gift of a retained life estate, and her home is valued at $250,000. That's based on $125,000 of land and $125,000 of the house. You have to separate those two, of course. And the federal monthly rate of 2.2% was in effect in October, and it's 2.6% this month in January. And you can see how much the deduction decreases as that interest rate rises. If you use the 2.2% rate from October, the deduction is $165,000, almost $166,000. As interest rates rise to 2.6%, that deduction declines to $158,000. And the reason is the retention of the home is considered equivalent to an income stream. And as that income stream goes up actuarially, that means that the donor has retained more, so the deduction goes down. So this is a gift which I think is good to remind donors who are thinking about making a gift that not only is it a good way to bunch a deduction because you'll generate a large deduction, but it's a good gift to make sooner rather than later because as interest rates rise, that deduction is going to decline. Now that'll be a little bit offset because every year the donor's a little bit older, but in a particular year as interest rates go up, the deduction is going to go down. So if someone is considering this gift, that would be the time to do that before interest rates go up anymore. Lynn?
Okay, thank you, Larry. Okay, we're going to talk about 8 best practices now for talking to your donors. The first 2 are something that has not changed and I don't think will ever change, and they really are focused on listening to your donors, understanding what they want, what impact they want to make in your organization, and what's important to them. So that, I think, will always remain the same regardless of any tax reform. Number 3 is to ask open-ended questions. How the new law impacts the donor. Don't just assume that they're going to take the standard deduction over the itemized deduction, and talk about some of the strategies and gifts that we talked about today. So, ask open-ended questions like, what are your thoughts, and how is tax reform going to impact you? Really increased disposable income as a result of lower tax rates and other factors of this tax bill. So ask them if they would consider donating all or a portion of that amount that they're saving in taxes to charity. I know I was talking with a financial advisor recently who had met with a donor, and now that this particular donor is no longer subject to estate tax, they increased their bequest by the amount that they will save in the estate tax. So that's just one example. Stock market, all-time highs. We talked about this, and it's a great opportunity to talk about your donors to consider giving their appreciated stock so that they will not have to pay capital gains taxes. Consider asking your donors to give an amount that exceeds the standard deduction that will go over that standard deduction amount so they can itemize. That might, and also talk about maybe bunching gifts in that respect. In CGAs, as Larry had talked about in the strategy section, I think you're going to have to be talking about whether they are going to be taking the standard or itemized deduction, and then determining what CMFR rate would be best for them. They may not always have a choice, but in many instances they may have, there may be different rates. So, for example, it's 2.6 this month, February is 2.8, who knows what it will be in March. And then finally, always think about honor and tribute gifts. We here at Stelter have done extensive research on this, and in all sectors across the board, nonprofits, donors prefer to give an honor or tribute to somebody that is close to them. So make sure that you are always promoting honor and tribute gifts. Making that emotional connection is very important for many of these donors. So let's go on to the summary. And really, the Tax Cuts and Jobs Act is already influencing behavior, and in a good way. Charitable giving was up in December 2017 compared with those numbers in 2016 for many organizations. Corporate America, one of the first questions we actually have from one of our attendees is about corporate tax cuts, and here's where charities are benefiting. So corporate tax rates were cut under the bill, and as a result, some businesses have given their employees year-end bonuses. They've increased the minimum wage. They've increased pledge commitments. And so, for example, here, Wells Fargo pledged to give $400 million to nonprofits and community foundations in 2018, which is an increase of approximately 40% from 2017. So that's how the corporate tax rates will be impacting charitable giving. The Tax Cuts and Jobs Act is designed to grow the economy, reduce taxes, increase wages, and create jobs, which are all good news for charities. So think of this as very positive. I remember a coach of one of my sons would say, attitude is everything. So I want you to make sure that you are thinking about the Tax Cuts and Jobs Act in a very positive manner, because I think it will ultimately be very good for charities. And just as a final wrap-up here, just remember that when you're thinking about tax reform and planned giving, that the opportunity for planned gifts remains unchanged. through every study that Stelter and others have commissioned, the primary reason for making planned gifts has been rooted in the love and passion for your mission, and tax incentives have always been at the bottom of the list. So just as we wrap up here, this has been a great start to understanding how tax laws impact your organization and donors. You probably still have more homework to do in regards to how it impacts your particular donors and your particular nonprofit. So continue to educate yourself, not only by reading or attending webinars, but by doing other things like that. And then also it's a good time to review your marketing and collateral material for outdated provisions. As we saw, many of the tax rates have changed. You want to be careful not to overstate tax benefits. So for example, the estate tax deduction, very few people will be taking that estate tax deduction. So you don't want to be highlighting it in certainly all of your material. So as you might guess, we have lots of questions, and I am going to be reading those questions off to Larry now, and hopefully we can get through quite a bit in the remaining time that we have. So Larry, I am going to read off a couple questions here from our attendees. Do the estate tax provisions also sunset in 2025?
Yes, they do. And they go back to the old rates with the inflation adjustment.
Okay, and can you give a little bit more detail on what the sunset period is? What does that mean?
Well, it's the same period as for the income tax deductions, which you talked about before. So after 2026, the estate tax exemption, the rates haven't changed, but the exemption will go back to what it would have been if the law had not been changed, taking into account the inflation adjustments. So it would have been $5.6 million this year if they had not passed a new law. So maybe it'll be $5 million, I don't know, $650 or whatever it is, taking into account inflation at that point if they don't change the law again. No, it does sunset with the other provisions.
Okay, are the tax brackets that I mentioned very early on in the presentation, were those based on adjusted gross income levels?
Which tax benefits now?
The tax brackets and rates that I had at the early part of the presentation, are those based on adjusted gross income levels?
No, those are based on taxable income.
Okay. And let me look at, does the 1.4% excise tax affect only private institutions?
It only affects private institutions because as a constitutional matter, the federal government can't tax the University of Missouri, for example, or a private or a public institution. There are constitutional restrictions on the federal government taxing state and local governmental subdivisions. So it only applies to private universities.
Okay. And the changes for the athletic boosters, is that only at private colleges and universities or public and private institutions?
No, that's for everyone because that is not a tax on the institution. It affects the deduction that the individual donors make. And it probably affects more the ones at public institutions because they're the ones who typically have the Big Ten football teams, which are hard to get tickets to. If you go to a small liberal arts college, you won't have that problem getting tickets.
Okay. A lot of questions on donor advice funds. Now that we've talked about obviously donor advice funds are very popular as it is, and maybe they'll gain some popularity. Do you recommend organizations to starting their own donor advice funds? Is this a trend?
I think that depends on how much use it would get and whether you think it will really increase contributions to the institution. If you do it, you might want to think about having a requirement that at least half of the distributions have to go to that institution. I'm not sure why a college would want to spend a lot of money setting up a donor advice fund where they don't get any of the benefits. So it may make sense for some, but for a lot of them, I'm not sure it's going to be worth the effort.
Okay. A couple of questions here on that 21% excise tax. Does that apply to public universities?
Yes, that's the excise tax on no, that applies only to also the private institutions for the same reason. You can't tax a governmental entity. That's the
Okay.
same issue.
Okay, for the 21% excise tax, is the 21% of that person's salary? Is that what's taxed?
Yes, it is. And then there are some specialized provisions for parachute payments and so forth, but it's essentially their salary. With the exception, again, for certain medical employees. So if you're the orthopedic surgeon and you get paid $5 million a year, then you would not be covered to the extent that income comes from medical practice.
Okay. Let's see. Is it better to wait until closer to the year to promote IRA rollover gifts? Closer to the end of the year, excuse me.
I don't know that it makes much difference when you do it, as long as you do it.
Okay. Let's see. Does the 21% tax apply to private secondary schools?
It applies to only to, it applies to any nonprofits. It's not just schools. It would apply to any nonprofits.
Okay. What is the tax rate for bonuses? Has that changed under the new law?
No, that has not changed.
Okay. Let's see. Does the tax law change anything about using S-Corp stock to fund a grantor CLT?
Well, again, the basic rules have not changed, but a grantor CLT can be an S-Corp shareholder because it's not considered to be owned by an entity other than the grantor. You have to be very careful, though, when that grantor status may end, though, including at the death of the grantor.
Okay. Do you know which
a charitable major trust, however, cannot be a shareholder of an S-Corp?
Yes. Yes. Do you know which states are more impacted by taking the deduction? So those higher states, I think I mentioned California, Oregon, New Jersey, that are more likely to take New York. Any other states in that list, Larry?
Well, I think it's really, as you say, it's the big states with either high income taxes or high property taxes or both. So think about areas where real estate's expensive, and you think about New York, and you think about San Francisco, and you think about states which in many cases are the same that have high income taxes, and again, that California and New York. So it tends to be states on the East and West Coasts, but not exclusively.
And last question here, and we do have several more, so feel free to email either Larry or I after this. So we're just going to take one more. Could you just go over once again what the tax rate on capital gains is?
Well, the tax rate on capital gains is 20%.
Okay. And then, but that is for the higher income donors. It's also 15%?
That's right. That's right. There's a range, but for the higher donors, it's 20%.
Yeah. Okay. We are out of time. I'm going to turn this over to Jen.
Great. Fantastic. Thank you so much, Lynn and Larry, both for spending the last hour with us. We had almost 1,000 people on the call. So that's amazing that you guys all decided to spend the last hour. As Lynn said, we did have a lot of questions come in. We didn't get to all of them. So if you have additional questions that you just need to know the answer to, both Lynn and Larry have graciously agreed to allow you to contact them. Their email addresses are on the screen. You see Lynn and Larry. And then if you have questions about the webinar itself, you can contact myself. If you have questions about Stelter's products or services, you can email Stella at Stelter, and you can also check out our website at stelter.com. One of the main questions I got throughout the webinar is, did you record it? Can we get the recording? Can we get the slides? And the answer is absolutely. We will be, barring any technical difficulties, I will be posting the recording along with the slides on our website. Those will be available by Monday. You'll also get an email from myself letting you know when they are available. But for sure by Monday, you can check out stelter.com/webinars to get that. And then I just wanted to once more give a shout out that we're going to do a second webinar. So if you had colleagues that didn't make it on this one, Lynn, what was the date and time again?
Yes, 2 weeks from today, February 7th at 2 o'clock Central Time, we will be doing an encore presentation. Again, we were close to 1,000 people on this call, and many more wanted to join in. So Larry and I will be doing an encore presentation of this in 2 weeks.
Great. And we will be sending out an invitation to that probably this afternoon or tomorrow morning, so look for that in your inbox and feel free to share. You can also go to stelter.com to register. So once again, Larry, thank you so much for your time and expertise, as well as Lynn. We really appreciate it. And thank you all for joining us today, and we will hope to see you in a couple weeks or for our webinar next month. Everyone have a good afternoon. Bye-bye.
Bye.